Righty ho, everyone, and welcome aboard. It is the 18th of August, believe it or not. We're counting down to Christmas yet? I don't think so. We're counting down to the trading retreat, right? That's the next big thing on the agenda. And that, of course, is going to take place end of November, early December. I can't remember the exact dates, but last week in November, certainly. If you are able to attend that, would highly recommend it to you. Righto, let's talk about, hang on till I see exactly what I can find here. There we go. That's what I was looking for. Pound versus the dollar. That's what we're talking about. Righto, we've got a range that is bounded by the breakout candle that's occurred in the last few minutes, actually. Hasn't been that long, that candle, in forming. I think that's probably due to the dollar breaking through the monthly pivot. Yeah, that's not there yet, of course, but you know, if you get that's a daily candle. I think if you got a 4-hour close above here now, you'd be talking breakouts. So no chart. Son of a gun. How can that be? It tells me I'm screen sharing. Everyone else got no chart? According to this, I'm sharing. I'll share again. You share. How now, brown cow? Gary, is that good now? Awesome. Thanks, guys. Thank you, Jenny. Rightio. Don't know what happened there. It said I was screen sharing. So this is probably due to the fact that the US dollar index, or the US dollar per se, is breaking through resistance as we speak. Been kind of waiting for that to happen for a few days. And it's not there yet, but maybe it does, maybe it doesn't. We'll see. I've got a couple of orders based on that, in fact, but let's get back to the pound. And here we have the range thus far, and I don't think this will change in the next 2 minutes, but it could. What we're looking to do here is identify the range since Hong Kong Open, which is there, right? Tokyo Open, which is there, and the range as high is here, the range as low is here. Then we find the midpoint, and that's where we enter the market. Now, if we're below that level, we enter long, anticipating that we're going to here. If we're above that middle line, we enter short at that middle line, anticipating that we're going to here. At this point in time, with a minute and a bit to go, we will be placing a long order here. So let's look to do that. Does look to be fairly bearish, this price action, but that's not the way we play this, so let's go with it. The entry level is going to be 120.27, I believe. Now, if you're new to this, I keep warning the people in the room, this is far from proven to work, right? So please do not put any meaningful money on this. I'll go back and have a look at the week thus far with this particular strategy in a little bit and see what we can find. So in my case, I'm putting 0.05 of 1% at risk here. And as I said, the entry is going to be 1.2027. And the stop loss will be where the low of the range is, which is 1.1994. And we'll get rid of that take profit pips. We'll put our first take profit, which is a bit of a misnomer, to be honest, because we're not going to take profit at that point. Here's our first take profit, which is, of course, the high of the range, and it's at 120.60. Is that right? Yep. Pardon my blindness. 1.2060, and we'll remove nothing, but we will move our stops to entry at that point. So that's all we'll do. If price actually goes to here from now, we will move our stops from where they are, which is here, to entry, which is there. Okay, pretty simple. TP2 we will explain a little bit later. It's a buy order. And there we go. 1,300. That'll do. Sorry, I'm looking at the expiry on this order. Entry, TP1, stop loss. Okay. We're good to go. Righto, now let's have a look and see what has happened thus far this week with this particular scenario. So we've got the open of Tokyo. Let's go back to Monday. Was the 0200 candle in my case, which is that one. The range would have been from there to, what's this, the 10 o'clock candle, isn't it? Yep. So we've got isolated 10 o'clock candle, which will be about there somewhere. Yep. So the range was here. Can't see the bottom of that bar, but let me find it. There it is. So I can tell straight away that would have been a loser if the mid-range is there somewhere. Let me see where it was. We've got, say, 60 pips of risk. So 30 pips from there, because it wouldn't have been a loser, was no entry. 30 pips from there would have been 120, 120, which is there. So no entry. End of day, you can cancel these. I said take your pick with that, because at the end of the day, we're looking for a breakout. But I think by the end of day, if it hasn't broken, then I would cancel the order. So the next day, we'll go to, there was no order there. Go to the next day, which was Tuesday. The 0200 bar is there. So the range is going to be 10 o'clock bar, which is, that's 11, that's 10. The range is actually at the 9, end of the 9. So it's very tight range here. Low here, high here, mid-range here. God, strike me, this is tight. Let me see, high there, low there. So that is 26 pips, 13. 13 from there. Sorry, this is probably boring for you guys, but is 120, 35 plus 13, 120, 48. 120, 48. That doesn't make sense. What was that range again? Oh, there's the high of that bar there, sorry. 26 is right. Now it makes sense. 13 pips from there is 47, 48. 48, which is there. So at the time, price was above the candle, needed to go short here, which we would have done. TP1 was here, which we would have hit and then gone out. Or no, it wouldn't have gone out. Stop loss is still intact. You would have got TP1 only, then smashed out. So break even trade, that one. Let's go to the next one very, very quickly. That was yesterday, of course. And we've got 2 AM bar, which will be that one. That's actually the 3 AM bar. Then the 9, which is that one. So the range is, wow, way up here. here to here, which is, let's say 50 pips. So 25 from there is going to be, wow, pretty much bang on that line, not so much. And the 9 o'clock bar saw us below that line, never got triggered. Okay. Whew. Took a while, guys, but we got there. So 2 no trades, 1 break even, and here we are again trying to find out how this will work today. Very uneventful week, I've got to say. Righto, let's catch up with my stuff very, very quickly. And I've got 2 orders in the market. One of them is Cad Swiss Long, if you want to follow that. It is an entry at 0.7411. And basically I'm trading this candle here. Trading long above it, stop loss below it, entry above it. TP1 is at 28 pips. And I think I've chosen that level there. $39. Yep. So I've chosen this level here as our first take profit level, at which time I'm going to close 50%. And I'll just make that a free trade at that point by moving my stop loss 28 pips from entry, depending on what happens here as to whether I'll move my stops to entry after that. So that's Cad Swissy Long. The other one is Euro Dollar. Euro Dollar short. Unusual for me to go short here, but I see the setup. So there we go. Very, very similar to what I've just seen. These are basically exactly the same trades. And by that, I mean they are false breaks of a support or resistance line. In this case, a support line. We've broken it. We've consolidated below it. We've come back above it. Now we've retested it. So my contention would be, if price continues to fall, happy days, who cares? But if it doesn't, then this candle means something. And we're going to here in the first instance, in my opinion, and then it can reverse. It may not. So Euro Dollar, pretty much the same scenario, going in the opposite direction. We've got a break of the resistance trade line. We've got a bounce off the top of the channel in that horizontal level. We've come back to the bottom of the channel, broken it, but we're not clear of it at this point. The key factor here is we've come back below the trade line or trend line in this case and retested it. So same applies. If it's not going long here, chances are it's going short and will probably challenge the lows if that's the case. If not, go back to trend, which of course everybody knows Euro Dollar is in the deep SH1Ts. So it wouldn't surprise me to see this continue lower, except that we're going below parity if that's the case. And it doesn't like that, but it doesn't mean it won't go there. So just a quick trade, really. There's no PP1 on this. It's a target only. And that is pretty much just above parity there, 100.35, I think I've chosen. So it's in here, out here, a little bit better than 1-to-1. Do have Aussie Dollar in the market at the moment. We traded this as exactly the same trade once again. Break, consolidate, back underneath, retest, and we got a nice entry on that yesterday. Got a TP1 here. Monthly pivot's going to be the issue, of course, and if we can get through that, my target is way down at these lows. So it will be a good trade if we can get there. It's already a winning trade because I've moved my stop loss to entry. So whatever we banked already will be kept. Just need to get through that monthly pivot. And as I said at the top of the show, it really all depends on how the dollar index performs. If we can get through this monthly pivot, then I think we're going to see a double top here at least, in which case we will see some nice profit on Euro Dollar and Aussie Dollar. If not, Euro Dollar shouldn't be triggered, and we've already got our money on Aussie Dollar. We've got some money on Aussie Dollar. So they're really the only three trades or 3 points of interest that I have at the moment. I do have one more that I had a look at this morning, and it's pound CAD. Now, pound is a beast of its own, of course, and subject to, I guess, what's going on in the UK. But also, if you're trading against the dollar, that comes into the equation as well. But the pound had some not good news, as I recall, yesterday. I've got no idea what it was, or wasn't paying too much attention, but I didn't think it was great news for the pound. But we haven't seen it fall that far. What we have seen is the failure for it to close above the weekly pivot for 2 weeks in a row. And you can see it kind of likes the weekly pivot. Every time it kind of gets there, it comes off it, gets there, comes off it, retests it, bounces off it, bounces off it, bounces off it from the underside, bounces off it from the underside once, twice. Is this the third time? Maybe it is. And that's kind of where I'm at. But it does have a dual setup for me. And one of them is long, and the other one is short. Short because I like the bounce off the weekly pivot. I haven't got anything clean other than that, but this is a classic slingshot candle pattern here. These three high test bars sitting on the fence, and that would, under different circumstances, maybe I'd be putting an entry above there with the stop loss below there. The different circumstances, as I say, is the bad news that the pound got yesterday. And I want to kind of go there now because I don't know anything about it. But the man who does is sitting right next to me on the screen. Here he is. How you doing, bud?
Yeah, I'm very good, mate. Yeah, so it's the CPI data that came out from.
Oh, that's right.
Yeah, that wasn't so good. I mean, we got CPI data this morning from the Eurozone as well, and that's going to be quite interesting because if it can't show that it is pushing down, then I think we might well start to see some doubts step in with the rest of the market, because obviously we've seen that the United States did release inflation numbers that were a bit weaker, so people were calling for a top and for a potential Fed pivot, or at least a softening in their stance. Then we get this CPI data from the UK yesterday, which was not showing that we're easing in any stretch. Difficult for the UK because they don't really have the same the same bed that the United States has to be able to raise interest rates with any kind of safety. So they are going to cause a recession, and it could be a lot deeper in the United Kingdom. Going to be as well, you know, when we start to see this data come from the Eurozone, then we might start to get an indication of whether actually stocks right across the board are overvalued, and these currencies may well start to see a move in a different direction. It's going to be, if we see the Eurozone's CPI data come hot, you would assume that would suggest that the euro is going to go higher, and you know, particularly because of what's going on in the United States. However, that might well pivot not too far away from that if people then start to realize that the United States number was actually the unusual one rather than the norm, and things start to change around again. So there's just a little bit of weakness now stepping in. So sorry, mate, go on.
Yeah, I don't see the CPI data as a normal read because inflation is so high at the moment. Generally, you would think, you know, a good CPI figure, you get a good currency bounce, if you like. I don't know that that's any longer the case, because to me, it's quite the reverse. You know, the higher it goes now, the worse it is.
Yeah, because it's about policy. You know, it's about you know, how will they sort of like adjust policy to curb the inflation numbers?
Yes,
but we're seeing weakness step in. You know, so where the inflation numbers are starting to be elevated again, you know, certainly sort of from the UK's perspective, the UK economy does not have the same kind of safety that the US economy does have to raise interest rates, not exponentially, but, you know, certainly kind of like maybe beyond levels that they thought were going to be done before. You know, they thought it would be around about 3 to 3.5%. Now they're talking about potentially 4.5, possibly even 5. The US probably couldn't handle that, but it can definitely handle it better than the UK can. So where CPI data should have actually boosted the pound, you know, with it coming out as hot as it has. We also know that the Bank of England won't be quite as keen to react off those numbers. And if they're not keen to react off those numbers, then that would suggest that the British pound is losing purchasing power as prices move higher, and you can't buy as much with the British pound, and they're not going to be able to fight that inflation by raising interest rates, or they certainly won't be able to do it that aggressively, because the rest of the economy just isn't in a good shape, really. I mean, you know, the unemployment numbers are about the only decent number that's coming out. But in the US, it's a bit different. You know, we're sort of we're okay. You know, the US is okay. I wouldn't say it's by any stretch really taken off by it, but you know, but it is doing all right. And you can see that with equities. You know, what's really been happening with equities in the US is that the equity market has continued to remain buoyant. And we said it yesterday. When you're ready, mate, I'll show you the charts on the equity market.
Go for it, mate.
Okay, well, we were talking about this. We were talking about this before, and what is it? Yeah. So this is the S&P, and we talked about this number on the S&P and said until the S&P kind of gets this level, there's not really a short in the market. Well, the S&P's now got to the level, and it has rejected the level just about. It might have one more push to the upside. A double top looks like it could be in play here, possibly. But it's a hair away from that particular level, and now that it is there, does the S&P do investors start to get a little bit nervous about the possible speculation that they've entered into? And the speculation they've entered into is that the Fed will become looser, you know, not necessarily, well, maybe loose is the wrong term, less hawkish. You know, that they won't be raising interest rates by 0.75%. And, you know, if you read the minutes yesterday from the Federal Reserve, then it kind of told you a little bit of that. You know, it intimated that what may well happen is that they may well get to the interest rate number that they are looking for, so the 4%. And possibly a little bit beyond, but around about that point. But they might do it more gently as they go. So raise interest rates, see if the economy absorbs it. If it does, raise it again, see if it absorbs it. If it doesn't, maybe hold at that particular position, or possibly even loosen. So the 0.75 interest rate hike next time out looks like it might be not off the table, but questionable.
Won't be the favourite, that's for sure.
Yeah, exactly. Well, and that's what speculators have really been banking on, that the Fed might become, as I say, less hawkish, and maybe, you know, they've been looking for a pivot, to be fair. Now, the minutes don't suggest that that's going to be the case. The minutes suggest that the Fed are going to continue to go. Now, they might not go 7.5, but they almost certainly will go to 0.5. And that would make this particular area possibly the area where the S&P is overbought, and you know, we'll see some retracement, probably only down to here, only down to that point. But that's still, what's that going to make? It's still a decent 2% drop down to that particular level. So so the S&P kind of like easing
where have
back.
you got that level, just for instance, interest sake?
Oh, what number? It's at on futures, it's 41.80.
Okay, I've got a level about 41, I think. If you were to put a parallelogram from the top of the potential inverted head and shoulders, so the left shoulder, there, no, next one down, that one.
From there?
Yeah, but swing it the other way. So swing it up. Now hit the current swing high.
Swing it up here?
Yep. Now bring the bottom one down to the right shoulder, left shoulder, sorry. There. Now whack that across and then draw a horizontal line through 41.
About there?
Yep.
Ah, there. Yeah. Yeah, that looks good, mate. Yeah, that does look good.
That looks reasonable to me.
Yeah, I think you're right. I think you're right. Now Jackson Hole is next week, 25th of August. We start to see Jackson Hole. Now, the Fed haven't really given that much away when it comes down to what they're going to do. What they're basically saying is we are data dependent. So depending on what happens to the data, we will react accordingly. Now, if the data continues to come out a little bit weak, then there is a chance that the Fed don't raise quite as aggressively. If the data is relatively strong, then they might well go quite aggressively. So that's what we're looking at with the Fed. Now, next week, Jackson Hole, we might actually get them saying that. Now, we haven't had any real information because the minutes are obviously from the last meeting. So that it's kind of old news, really. But it might be Jackson Hole where we do start to see this market reverse. And that's, as I said before, either the trend line comes to the price or the price goes to the trend line. Now, that might well run quite nicely into next week, because one more push to the upside would see that this is the 25th. So if it dips down to the weekly pivot, dips back up again, one more push here would see us on the 25th, and that's maybe when you start to see this move down, particularly if the trend line starts to meet that horizontal level. But I think you're right. I think the market is under a little bit of pressure. We've been pretty keen, and the argument's always been, are we in a bear market rally, or have we actually turned around, and is this now a bull market?
Is there a reason for it to turn around? I don't see the reason.
Not really. I mean, the
Hi, Wilson. Wilson's on the train. G'day, Wilson. How you doing?
Hi, Wilson. Yeah, but not really, except for earnings season has been pretty good.
Pretty good.
Now, I don't know whether what we could be looking at is Q3 as the turning point, and that's what everybody's worried about. They're looking for a quarter where recession's sort of like one thing, but do these earnings expectations start to miss? And I think a lot of people are suggesting that will probably be the case. I mean, the FTSE 100 is a different beast because of the type of stocks that are doing well in this environment. One of the reasons that the S&P is potentially going to be dragged lower is because it's so tech heavy. It's got some of those tech names, which means that the growth stocks are potentially going to get in a bit of trouble if the Fed continue to raise interest rates. Whereas the value stocks and the stuff the staples that are in the FTSE 100, i.e. Shell and BP and Unilever, Rio Tinto, and those types of things, then because of the nature of those things, the FTSE may well manage to hold a little bit better than the US companies. But it's
pretty much done that through all of the pandemic, hasn't it?
Yes, it has. Yes, it has. Yeah, even when it tanked, it didn't tank anywhere near as much. So so the FTSE has been a pretty good hedge against the US companies. But you'd want to go for long FTSE and short US companies. So that trade still looks like it's on. The FTSE could do with, when you look at the FTSE could really do with getting up to this level before we really sort of take a look and say, okay, that the move is probably done. But in that, in saying that, this could quite easily sort of, ease back before it sort of has another bite at that. And if the S&P is going to be coming down over the next few sessions, then you'd imagine the FTSE will probably follow. So, so the buy opportunity on the FTSE is probably looks like around about 3% dip on the FTSE. 2.5-3% dip on the FTSE could well be on. But it might get to that level first, and it really does depend on what happens over the course of, and you see this a lot. If the S&P is coming down, then you'll see that pretty much all the other markets will come down with it. But what can happen is that the S&P can unwind a little bit. And as that's unwinding, the FTSE stays where it is, for example. And when the S&P pushes back to its previous high, the FTSE actually breaks its high and goes to the next level of resistance. So they basically start to meet at a level of resistance before they both turn around. So we might well see the FTSE come off the back of that. The currency that was picked for the week was the Aussie Yen as a short, and given the dynamic that we saw yesterday in the market, it looks like this Aussie Yen as a short is working out well. We talked about this one on Monday, and suggested that we could see some further downside. Now at the monthly pivot, might start to see a little bit of support, but if the S&P does break down, which there's no guarantee this week, but you think into next week it could happen. Aussie Yen might have some further moves, might have further to run to the downside.
What chart are you on?
This is the Aussie Yen 4 hour.
4 hour.
Yes.
Wow. Okay.
Yeah.
Hey, I got it.
Decent opportunity, really. With the Aussie Yen, it's certainly as the week started, we came straight back down again. But over the course of Tuesday, we did get this rally right back into the weekly pivot. So trading between the pivots, there's been a decent 100 pip move on the Aussie Yen.
I chose Aussie dollar over it because I thought the dollar was a little bit more trustworthy than the yen. I mean,
yeah, difficult. Yeah, I think you were right on that one as well, mate. I mean, it's the dollar is definitely more trustworthy. We compare the dollar yen, and you can see that the dollar has rallied. If we go to the weekly, you can see the bars green. So the dollar is the stronger currency of the two.
Today's going to make a massive difference if it gets through that high there, which is the monthly pivot, really.
Yeah, it really will.
To the top again. Yeah.
And this is sort of like all interlinked, isn't it? So we're talking about what happens to the S&P. Well, what happens to the S&P? The reverse is likely to happen to the dollar. Do we continue to push to the upside now with the dollar after those Fed minutes, or are we also waiting for Jackson Hole before that comes in? Philly Fed manufacturing minutes out later on, unemployment claims, and we got FOMC member George speaking. Actually, the existing home sales number, that's another thing about the pound. The UK economy, we are starting to see strain when it comes down to certain sectors. But the reason the CPI data is so hot is energy is still very high and food costs are very, very high. So, really the things that you do not want to be elevated are the things elevated. What you want is CPI data being high because house prices are high, because people can choose not to move, but they can't choose not to eat or heat their home. So it's the worst type of inflation data really that we're getting. And as I say, we got existing home sales from the United States later on. So we got unemployment rates. The employment rate in Australia took a nosedive, but we got the unemployment rate at 3.4%. So tight labour market.
It's a little bit tricky, that number, the unemployment rate, because that's not a good figure, the change, right? But I think entangled with that, if you read into the unemployment figure, there's actually less people looking for work.
Right.
And of course, that's going to show as a good unemployment rate. So if there's less people looking for work, there's actually less people unemployed, right?
Yes.
So it all does lead to the one place, which is kind of full employment. But I think that number is a little bit tricky. And if you have a look at the chart on the unemployment rate, it's it's at all-time lows and getting down. Just like any chart, that's not going to go through the bottom, in my humble opinion. That's going to raise at some stage.
Yeah.
So I don't think that's as good a number as it looks, is what I'm saying.
Well, I think that's an interesting point, mate. And if you look at the actual employment change, then you can see it was negative. So if we start to have a look at that chart as well, I mean, it's been okay. It's been relatively robust, but you can see that, over the course of, since the turn of the year, really, it was on a relatively even keel, I suppose, but a big dip down in the employment
But
change.
Have a look at the big dip, right? Which is obvious. That's COVID. That's COVID.
Yeah.
When COVID kicked, it only lasted. You're on a quarterly or a monthly? Is that a monthly? Must be
monthly. Yeah.
It recovered really, really fast and stayed above the zero line, if you like, pretty much ever since. Bar 5 months of 2.5 years. That's not too bad.
Yeah.
At the end of the day, but why suddenly have we gone from 90,000 in new employed to 50,000 unemployed, not employed? I don't trust the figures, mate. Seriously.
Yeah.
There's too many variances for me.
Well, there are. I mean, to be honest, the central bank needs that anyway. The central bank in Australia needs to start to see the employment level come down, really, because of that's one potential driver for inflation. If
wage rises, absolutely.
Yeah, just a lack of demand as well. So that'll be a welcome number if this in some respects, but this isn't particularly. But this is what I was going to really talk about. So we got the Philly Fed manufacturing index later on, unemployment claims from the United States as well, and existing home sales. Now this is quite an important one, because the existing home sales obviously shows you the strength of the consumer. It's quite a good look into the strength of the consumer, and the United States is so reliant on their consumer that you're kind of going to want to see those numbers continue to hold up if the Fed are going to be coming out and sort of like continue to raise interest rates. Now, if they don't do that, which it probably won't, you'd think that existing home sales number will come down. The forecast is for it to come down. You think it would be a bigger dip than this, and the reason for that obviously is that mortgage rates have taken a hike. So if mortgage rates are taking a hike, you'd think that more people would be tightening their belts and potentially staying where they are. So we might start to see the US economy get a little bit hurt, and if that's the case, it's possible that we'll see that number come out, and all of a sudden the S&P and everything else starts to rally off the back of it, because bad news currently is good news, and the reason for that is because of the expectations from the Fed. So we're really starting to flip our perspective, and it's interesting when you look at data, because data if you click on the folder would tell you, let's say final CPI data as an example, actual greater than forecast is good for currency. Well, not always. Not existing
in this case.
No, it could be as we saw yesterday. If we go back to what happened with the United Kingdom, CPI data here, look at that, 10.1% from 9.4%. Actual greater than forecast is good for currency. It's got a
green number. If you're a young trader, if you're an early trader, you read that, you're going to say, okay, I've got to buy the pound. Yeah,
exactly. But then if you look at the rest of the healthy economy, and look at this. This is the interesting thing. HPI is the housing price index year on year. Look at the drop, 7.8% from 12.8%. This is telling you that people are not moving house. So the consumer is not in rude health, at this particular position. So if the consumer's not in rude health, then how can the Bank of England come and say, tell you what, guys, we can fight this inflation by raising interest rates, no problem at all, because you guys are in a good position. You can handle it. If we do raise interest rates, you guys can handle it. Well, some of these numbers are suggesting that that's just not the case. And as I say, you break this CPI number down, then what you will see, particularly, is the cost of food is the thing that is elevating the CPI data. So this is not the kind of numbers that you want to see if you are trying to protect the consumer, and if the consumer is the actor that is going to get you out of this situation. It certainly looks like that's just not possible. And a UK recession, I think, is is
Yeah,
well and
which is a
truly.
really good lesson at the moment. The devil is definitely in the detail, especially in
Yeah.
those numbers we're talking about. You've got to dig a little bit deeper than the headline. That's for sure.
Yes. Yes, you do, mate. Yeah, you do. You have to read the report. I mean, it's, that's what I do, and it's not a particularly time consuming thing to do. You just kind of just have a look at when the release is out, check out the report and see what it says. It's just a lot of numbers, really. But when you break down the list, and that's what they give you, the list of numbers, the list of where the CPI data's come from, then when you look at the list, you can kind of see where the prices are being hiked. And then you get a decent feel of why that's the case. And you know that the thing that's going to change the CPI data being where it is one of two things: either a supply a change in supply, which is not looking like it's going to happen because much of the food is coming from Ukraine, or a change in demand. Well, that can't happen because people need to eat. I mean, the only thing that people will do is potentially go from buying Marks and Spencer's brand, which is one of the best brands food-wise over here, to going and buying Lidl, which is one of the cheaper brands. I'm not going to say better or worse, just cheaper or more expensive. The budget, yeah, they'll go to the budget stuff. Which we're starting to see already. You start to look at you look at the earnings from a company like Lidl, and they are outstripping everybody. And the reason is everybody's sort of like aware of what's going on, and they've switched their shopping habits already. They've started to switch around. So, again, it's one of those one of those examples that you go, food price is high. So the spread trade, where you buy one, what we're doing with currencies is spread trading. We're buying the Aussie, and we're buying the dollar and we're selling the Aussie. We're buying the yen, we're selling the Aussie. That's what we're doing. Now you can do the same thing with this stuff. You can go out and buy Lidl and sell Sainsbury's. So that way you're protected because you've got the sector. But if you think that Lidl's going to outperform over the course of the next 3 months, which this suggests it will, then you can buy one supermarket and sell the other supermarket, and you got your own special little spread trade kind of packaged in.
It's a great way to look at the market, in my humble opinion. And I've only just started doing that, I've got to say, because I now realise what's coming up is a massive opportunity in the stock market. But there's also a massive opportunity going the opposite direction, which I think we're still doing. I still think we're in a bear market. So look at those, just as you've described, hot items. And it's not that hard because you just have, hang on, where are we at the moment? Okay, we've got inflation going out of control. We've got people suffering because of that. What's going to give first? Food. It's the first thing that's going to give, right? Because that's the one thing that we always need. When I say give, they're going to look for bargains, as you just said. What's going to crumble is things like subscriptions, again, like we saw at the beginning of COVID, right? So a Netflix rally, which was what we've just seen, to my mind, is a false rally.
Yeah.
Given the circumstances, because people will have less disposable income. And when you've got less disposable income, the very first things that go are your luxury items, like your streaming subscriptions. So I think, if you think of the market in that vein, at the moment in particular, because things are extreme, you're going to get a very, very good read on where you should be putting your money. I believe. Absolutely
right, mate. And the interesting dynamic with stocks is that inflation, if they've got their house in order, inflation can actually boost stocks because they don't need to have volume to increase the operating margin. If their operating margin is pretty much sort of like at the same, costing them the same, certainly sort of like producers. If it's costing them the pretty much the same to produce the item, which with if you look at the wage index, then employment data is suggesting that wages aren't going up anywhere near as much as inflation. So actually, the labour market's not costing them as much. So if that's the case, and yet they're charging more for their products because of inflation, then their operating margins are doing very, very well. So you don't really. So at this particular stage, stocks will probably do okay, but at some point, when the turn happens and the supply, as you say, comes out of the market. So if the supply stays the same, but the prices have gone higher, then they're in the same place for volume, but they're making more money. Well, if the supply comes out of the market and all of a sudden they have to lower their prices, then that's when you'll start to see the shift in the sentiment, and that's when potentially that leads to recessions. So it's an interesting situation right now, where if you look through the likes of Netflix, you won't see any greater subscription, and that's their job. Their job is to get more and more subscriptions. That's how you grow the company on the kind of 101 economics 101 level. Well, that
which they've tried to do now, right? They've got a new policy in place, and that's why they've seen a rally because of that. But to me, it's a false rally, because if the demand is not there, they're trying to create demand, right, for their services. But as I said before, if the demand's not there, if inflation remains high, people have got less disposable income. It's one of the first things that just crash.
Yes,
is subscriptions, streaming subscriptions.
But you see, I guess that's the balance, isn't it? Because if the cost of subscription has gone up by 10% and they lose 5% of people, they're still net profit. So that those numbers eventually do start to even them, equal their way out. But right now, they're in a situation where they've raised their subscription costs. So actually, they are still managing to kind of make profit on, they're still managing to beat the earnings expectations at this stage. But as you say, things will change, and maybe we see that, as I say, in Q3. Maybe Q3 is when we really start to see a poor earnings season. It's not happened yet.
And talking about inflation, I mean, that means we've got, if you're holding cash, you're losing money, right, at the end of the day.
Yeah.
So that brings in the conversation around gold, silver, precious metals, anything of that vein where you can store your wealth. And, I'm starting to get very interested in buying physical silver. As I said a couple of months ago, I can't anymore because it's gone up, but I could buy a kilo of silver for less than $5,000, which is superb because I don't have to report that. It doesn't have to be reported. So I can hold that silver without anyone knowing, basically. Whereas including the tax department, of course, who's listening? So that's very attractive at this point in time. But that's just gone over that 5,000 figure, so makes it a little difficult. I noticed silver's come off again in the last few days.
Silver has come off. I mean, if we're sort of like if we're looking at gold and silver, they both ease back down again. Bring this in here.
Does everyone realise how manipulated these things are, by the way? The price that you're seeing on your screen is the spot price for silver. No, it's not. It's actually the paper price for silver. There is no real price. There is no real price for silver at the moment. This is the traded price, right? If you have a look around and just go through the exercise, wherever you buy your precious metals, if you have a look at the moment and try and buy a kilo of silver, you'll find it's very hard to find, because the demand for physical silver at the moment has gone through the roof, absolutely through the roof. And eventually the market will catch up with that. But whilst ever it's the price on a spot basis is being manipulated by the likes of JP Morgan and the rest of them, who for whatever reason want to keep the price of silver down. And I don't know really what that is. Maybe they just keep making money out of buying the rallies or selling the rallies. I don't know. If you look at the charts, that's probably the case. But I've actually got something that's interesting to listen to if anybody's interested in that, and I won't put it in the chat unless you are. It's what I virtually said in an hour format, which is absolutely makes perfect sense to me. So if you want me to give you that link, I'll put it in the chat. But I have to see some yeses. If I don't, then I won't bother. I might be just completely wasting your time. You might think it's a conspiracy theory. But what you're seeing in silver is not really reflective of what's going on in the silver market, in the physical silver market. This is just paper. Like we trade, a speculation based on paper. It doesn't exist, right? Physical silver is the only thing that exists. And as soon as these dudes finish messing around with their paper trades, the price of silver is likely to go through the roof. And gold would be the same.
Yeah.
But silver's a far better transaction, in my humble opinion.
Yeah, just a difficult one though, isn't it? I remember we picked up silver at the lows, and I guess we're probably back to that point now. If you look at the silver chart, then we have this level along here, which was a beautiful point, really. I mean, it literally touched it by the cent, and just started to bounce, and it created this pin bar, which you would expect that to eventually result in some upside. So if you're liking silver, then it looks like a pretty good point to be looking to buy back into it again. If you're
look, I love physical silver at the moment, but understanding how successfully, if you like, this market is manipulated in paper terms really makes me a little bit dubious as to when to get into it, frankly.
Yeah.
I think I'd rather sell it on the rallies than buy it on the dips.
Yeah.
But eventually it'll take off. I've got no doubt about that.
Oh, it definitely will. I think the big problem with silver is the fact that it's that it is part of the makeup of growth as well, because it is used as an industrial metal. So if we are starting to see sort of like growth come off a bit, then will silver do quite as well as gold? And you'd think it probably wouldn't, because as you're sort of like saying, if you've got your money as cash, then you're losing purchasing power all the time. So people will go out and buy gold just to kind of secure their position.
That's right.
But with silver, you might be less likely to do some of that, and as I say, it's much more likely to get a boost if the stock market is doing well.
The other way to look at that, of course, is gold's useless apart from a storage of wealth. It does nothing else. Silver does plenty more than gold, because it's used in plenty more applications. The only thing gold is good for is making wedding rings and crap like that, or storing it in bars. Whereas silver, it's used in many, many applications, including, an aircraft and all the rest of it. There's a whole heap of uses for silver. And from what I'm hearing and reading and listening to, there is a worldwide shortage right now of physical silver.
Right. Yeah. It'd be one of those, mate.
Similar to uranium.
In a few months' time, we're going to see this, as you say, or certainly a few years, we're going to see it probably double in price, and it wouldn't take much, because it's at $19 right now for silver. So and you look at this chart. This is the high on the chart at near $50 an ounce. So it's currently at 19. So for it to double in value, it just gets back to its previous high. So silver is one of those currencies, one of those metals that could do very well. Very volatile markets, silver, which makes
tough
it
to trade. Really tough to trade.
It is a tough one. Makes it a good one in some respects as well, though. If you were picking the really volatile markets that would be good for intraday traders, then silver certainly comes up there, as does the Nasdaq. There are certain things that are more equal to trade than others, and silver's much better than gold on that respect.
Yeah, look, I totally missed the trade actually on silver. There was a game changer bar on Friday of last week, So you could have picked that run up down to the monthly pivot, no problem. Missed it completely.
This one here?
Yep.
Yeah.
Because you had to see it on Friday or Monday, I suppose. Oh, no, gap down. That's right. Couldn't get into it.
Yeah.
No retracement.
No retracement. No. It's a tough one, that one. So really sort of what we're looking at today, mate, is pretty much continuation. I do think that the S&P is on its way to turning. But I wonder whether we might see one more high before we genuinely turn. As I say, Jackson Hole is kind of like the big event now, and we don't get that until next week. The numbers from the United States today might just kind of like, push things back a little bit in how we kind of judge this market. But if we look at what we got here, so we got some the stuff today. Tomorrow there's not really anything going on. Then we kind of hit next week, and it's next week that we might start to get some movement again. Nothing major. Oh yeah, flash PMIs from the United States actually on the Tuesday, but it's the Jackson Hole Symposium, which is on Thursday. Sorry, Thursday next week. Which here we go, Jackson Hole. That's a thing to look out for. Purely because it's full of central bankers, and they'll talk.
Yeah, first time I heard of Jackson Hole about 12 years ago or something like that. I thought it was a golf game. It was fun.
Yeah.
Well, they probably do play golf over there.
Yeah, I'm sure they do.
Yeah. Nobody's asked for this link, so I'm not going to post it. I've got no affiliation to this mob or anything. I just find it very, very interesting. I'll send it to you though, mate, so you can have a look at it.
Yeah, that'd be great.
It's very, very interesting. Righto, what else have we got? Euro dollar. We haven't had a look at euro dollar. Should we do that?
Let's do it, mate. Yeah, let's do it. I mean, the euro dollar is an interesting one because I think the euro is coming kind of back into the mindset now again. With obviously we got data today. The euro is in a situation where it's going to find it difficult really to move because their policy cannot be quite as tight as the United States. But yeah, euro dollar, you would be looking for an eventual turnaround in this currency, but I just don't see where it's going to come from. I really don't. I think that this has got a pretty good chance of getting right back down to the lower end of the channel again, which puts it at 98 cents for the dollar, which people I think would doubt that possibility could happen. That it goes below parity. Yeah, but I just don't see the euro going anywhere else but down. Really,
well, I've got a sell order on it at the moment, so that's my opinion. But
yeah, well, it's just
it's tough to read that the euro.
It's tough to read, but it's in the same situation as the United Kingdom, and we know what the problems were last week in Germany with the Rhine. We know what the problem is with the Ukrainian situation. The heat wave now hasn't helped, and it's just compounding problems in the Eurozone and the UK, mainly because of geography and proximity. But if you're going to trade two currencies short, you'd be looking at the euro and you'd be looking at the pound because it may look cheap, but in some respects, can it be too cheap if things fundamentally haven't turned around for them? Probably not.
Well, I think it has to wait for the dollar to weaken before it rallies.
Yeah, well, that can happen.
Which is another way of saying exactly what you just said. It's got no credentials against the dollar until the dollar weakens, in my humble opinion. There may be other weaker currencies, but gee, they're hard to find at the moment.
Yeah,
that's for sure.
Well, I mean, I was even thinking euro yen short this week, but I think that actually did okay, and maybe the CPI data is some of the reason for that. There's euro yen. Yeah, it's doing well. I mean, it's doing okay. I thought that might be an option for a short. If Aussie yen was the short, but this was an option for a short. It might still turn around. It's possible. That with a couple of days to go, that this does start to weaken again. I think that the data later on is going to be quite significant. And it's difficult to know which way it'll go. CPI data coming out hot may well not boost the euro. We might actually start to see this turn around because of lack of room that it has.
Yeah, I had a really good exit last week and a really bad exit last week. Aussie Swissy, which I was in short for, I think this was the 4th week.
Oh yeah,
this would have been the 4th week I was in that, and it just would not move. And I got into a hedge trade, not direct hedge, but it looked hedgy, so I took the trade. Kiwi Yen long against Aussie Swissy short, and Kiwi Yen did exactly what I wanted it to do. It went to a resistance level, so I closed that trade, which was a nice hedge. And when Aussie Swissy got back to break even, so the net 2 trades were break even, I closed that, which is, I'm completely okay with that. That's what the hedge was all about, is to get to break even rather than take a loss. And now Aussie Swissy is just smashed through the support level. And of course, I've left how much on the table so far?
yeah.
50 pips. But you can't be disappointed when the market actually does what you ask it to do, and that's precisely what I did. So
no timing,
but it was a horrible exit on
Yeah.
Aussie Swissy.
Timing is everything, isn't it, mate? Sometimes, but we all know that you don't, you can't really. I mean, to sort of like to get the right timing all the time is impossible, but to get the right timing sometimes is a challenge. So it's just one of those things. If you're in the black, then I guess that's still a positive.
Yeah, look, if the trade's not working, which it wasn't, and you're into drawdown that can go to full loss, and you get the opportunity to get out at break even, you're going to take that most times.
Yeah, for sure.
And that's exactly what happened there. So I don't have a problem with it. It was just a SH1T exit, simple as that. But based on good theory.
Yeah. I don't have anything else, mate. I've got a couple of positions that I'm working on myself at the minute, but I'm not going to really be doing anything with anything. I'm just going to let things rest and see if they can go one way or the other. But I am ultimately with you on the market. I think that a little bit bearish, but I think that the timing isn't quite there yet.
Okay, I've got a couple of things to look at before we Vamuski.
Okay.
And sadly, both against what we've just spoken about on the charts. There you go, Paul P. Pound yen. I have still got that order, yes. But what we've just spoken about doesn't fill me full of confidence, nor does the chart, frankly. If you look at this chart, it is absolutely like a dog's breakfast. It is all over the place. That's on the weekly basis, right? But, the setup hasn't changed. Really, we've still got the game changer bar from what now is 3 weeks ago, or nearly 3 weeks ago. You still got the inside bar, and you've got a candle that's absolutely done nothing really the entire week. The one thing that it hasn't done is taken us in, I suppose. Has put in a lower low than the inside bar, but not a lower low than the game changer bar. So whilst ever that's still the low, I'm still happy to say that this can go and challenge our TP1. So yes, I am still in that order. The other one, pound something. Pound dollar has just triggered. So we are triggered long in that breakout trade, if you like. I've got to stop calling it a breakout trade because it's really not that anymore. It's more a London Open trade. So we have been triggered long on that. Here's our take profit level up here, and we will move our stops to entry if we hit that level, which is 120.60, and then close, which I didn't say before, at 2.5 to 1 the risk. So that would be, risk is what? 35, 2.5 35s is 70 and 17, 87 pips from here. So we're looking at 121.14. If we're fortunate enough to get to there, that's the exit point. So no TPs, just get out. That's it. So that would turn out to be a 2.5 to 1 trade if it were to go there. But we've just discussed the pound and its potential for strength, which is below zero. It would appear. So yeah, maybe that's not going. Maybe it is. I mean, we're only talking intraday. We're not talking longer term on this particular scenario, and it is at a support level. So I've got no problems with taking it to there. That kind of works for me. Nothing's going to change. It's still in a perhaps situation. You've even got an inverted head and shoulders sitting there, which may turn out, may not. And the pound yen, like I said, it's a big mess. But ultimately, you're in a pretty strong uptrend. So going long doesn't make a whole lot of bad sense to me. Just got to, I guess, work out where the strong resistance is. And it's beyond our take profit level. So I'm fine with that. After all, we're going high highs, high lows, high highs. A little bit of a tweezer top sitting there might be an issue, but there you go. I don't, there's too much more from me, to be fair. We've spoken about the euro. Oh, okay, let's go with the euro. We're now getting a classic potential false break of support. Would I be interested in trading this long is the question. Have I got a target? Yeah, not enamored by it, I've got to say, but there's probably a target up here somewhere. No, not a fan. We've lost our edge in fact, if there is an edge that we're showing on euro dollar at the moment, it is that the daily pivot's been both broken and retested, which is giving you a bias to the downside. I don't think I'd like to trade this long at the moment, not at all. But of course, we go back to the place we started today, and everything hinges on this, in my humble opinion. If the dollar can break through this level, then we're up to here somewhere, and that should make a bed in which you can lie on just about everything that surrounds it. Certainly everything against the dollar, certainly the indices as well for the short term.
Yeah.
So everything to my mind hinges on this chart. If it breaks through there, it's a big yes for the direction that I've taken. If it doesn't, then I think we need to look in the opposite direction, because we're going back to this trade line or trend line. That's in my opinion. So there you go, mate. That's me as well. I'm done for the day. I've still got a bit of management to take care of, and if we do get in, if this does break through, I'll have a few more trades in the market as well. So I may have to work tomorrow. Don't like that.
Okay, no worries.
I think
I'll be around.
I think we've got Simon back on Monday.
Okay.
I think we've got John still in the great abyss somewhere. I don't know where he is. He's kind of in between Malaysia and Tasmania somewhere. He said he was coming down to pick some weeds out for me. I don't know if he's still doing that. We shall see. All right, mate. So have a great weekend.
You too, buddy.
I will send you that link. Nobody else seems to want it, so that's all cool. And thank you guys for being our trading buddies. We enjoy your company. We enjoy your input as well. So don't be afraid to put those questions in there. Look at some charts, anything, any ideas you might have, you're more than welcome to share them. Have a great weekend, everyone. Thanks, Marlon, for looking after us, and we will see you on Monday. Bye-bye for now.